Hi, everybody, and welcome back to video number 3 in chapter 11. And here is a different class of stock called preferred stock. Here, we're issuing 50 shares of $100 par value preferred stock for $6,000. Preferred stock is very much different from common stock. There's no ownership in the company, and mostly all you're legally entitled to is your preferred stock dividend. You have no voting rights. And so why do we call it preferred stock if it doesn't have any of those advantages? Well, the reason we do is because in the event you pay dividends, you must pay the preferred stock dividends first. And then you can pay any leftover to your common stock holders. Also, in the case of bankruptcy or liquidation, the preferred stock holders do get paid off before any common stockholders get anything, which is usually not very much. So here in this example, Dylan has issued 50 shares of $100 par value common or preferred stock for $6,000. So we get $6,000 here for that for issuing that stock, and we would credit preferred stock $100 par value for $5,000, and the paid-in capital in excess of $5,000 was $1,000. And so pretty much the same way that we did the common stock. Now here, under the stockholders' equity section, we're going to have a classification of stock, preferred stock, and paid-in capital in excess of par, preferred stock, and then our common stock, and our retained earnings, and our total stockholders' equity. So now, why would you issue preferred stock? Well, you're not giving away control. There's no ownership of the corporation, and you can raise money that way. And therefore, your return by common stockholders is going to be better. Because we can essentially borrow money by issuing preferred stock. And it appeals to investors who may believe that the common stock is too risky. That seems very counterintuitive to me. I don't think I would get involved in a corporation that had a risky scenario if I'm buying preferred stock. Mostly preferred stockholders go to very conservatively managed, mature blue chip companies for that because they want their return, they want their dividends. And or they might think common stock is too low. They could think that too. All right, we have two classifications of preferred stock: cumulative and non-cumulative. Almost always, preferred stock is going to be sold cumulative. And you'll see why that's an advantage here in a second. Because any dividends that aren't paid in a previous year, that's going to be called dividends in arrears. Those must be paid in total for any back years before you can pay any common stock dividends. However, if it's non-cumulative, we only look at the current year, and we don't look back at prior years that have to be paid. So you'll see how that works here in a second with the arithmetic. So here's an example. In year one, we paid $5,000 of, this is a cumulative scenario, $5,000 here. And then how much were we in arrears? Well, they say we were in arrears $4,000. So that suggests that we have to pay $9,000 as our normal dividend that we're going to pay to our preferred stock dividend stockholders. And so we were 4,000, this was 5,000, so 4,000 is the amount in arrears, the difference between 5,000 and 9,000. And now it's the current year, and we're going to have to pay off the current year's preferred dividends of 9,000 plus the previous year's dividends in arrears. So the total that we're going to pay is 13,000. That leaves us 29,000 remaining to be paid to the common stockholders. So year one and year two are going to be 18,000 and 29,000, and that 18,000, of course, represents 2 years at 9,000 a year. Okay, now if it's non-cumulative, we only pay 5,000 in year one, but we don't have any in arrears. So along comes year two. We just need to pay the current year's dividends, and we're free to pay that remaining $33,000 out of the $42,000 to the common stockholders. You can see that in this scenario, the preferred stock dividend holders got stiffed by $4,000 in this scenario. Okay, let's take a look at purchases and sales of treasury stock. Well, treasury stock, we're buying back our own shares. And I've only done that once in my career, and that was at Chrysler. And we felt, senior management felt, that Chrysler, coming back from almost bankruptcy, they didn't feel that the market was recognizing the tremendous progress that Chrysler had made. So they said, okay, we'll show you, we'll buy our own stock back as an investment. And it worked. It maintained a strong market for that. And when we did that, the price of Chrysler stock went back up to something that was reasonably justifiable. But you can use some of those shares if you want. If you want to buy back some of your shares, you can use those shares to buy other companies for stock. You might want to reduce your you might want to reduce your cash holdings and put it into stock so that it avoids a hostile takeover by another company. And every now and then we reissue those treasury stocks to employees as one form of compensation. Okay, so most big corporations do have treasury stock. And in this case, Cyber Incorporated purchased 1,000 shares of its own shares in the open market for $11.50. So it cost us $11,500, 1,000 times $11.50. So we charge that to Treasury Stock Common. Okay, and you can see that that's a debit. That's going to reduce stockholders' equity, and we're going to pay out this cash here. So it reduces stockholders' equity on the balance sheet. Now, sometimes we want to sell, as we did at Chrysler, that treasury stock back to the public, in which event, in this case, we sold it exactly for what we paid for it. 100 shares out of this 1,000 shares, we sold 100 shares back at exactly what we paid for it. So it's an easy transaction. We debit cash and we credit Treasury Stock Common, an exact reversal of the previous journal entry. Now, if we sell it above what we paid for it, which is what happened at Chrysler, I might add, we're going to debit cash for the full $12 times 400 shares, or 4,800, but we have the 4,600, that's $400 times $11.50, gives you 4,600. But the paid in capital treasury stock we're going to have is $200. That's a tricky little number, as I think you'll see here in a second. So keep in mind that we have that paid in capital of $200 here. Next, they sold 500 shares. Now, that was, we had 100 that we sold at what we paid for it, 400 that we sold for more than we paid for it, and now we have 500 that we're selling for less than we paid for it. So what we do is our cost was $11.50. So our Treasury Stock Common, we're going to reduce by that total cost. But we only got $5,600 in cash for that. That $150 is going to reduce, that difference of $150 is going to reduce that paid in capital that we had here in the previous slide, is going to reduce that by $150. Okay, see how that works? That can get a little tricky. Okay, so what are the items reported in retained earnings? Well, here, retained earnings, again, is the cumulative amount of reported net income offset by any net losses we've had through the years and any cash dividends that we've declared. Notice that. Not necessarily paid. Maybe previous years have all been paid, but the current year might be declared. All right, so we have a legal restriction in most states that say that the amount of Treasury stock purchases to the amount of retained earnings. We restrict the amount of Treasury stock purchases to the amount of retained earnings. But we also have some contractual restrictions. If I'm the bank and you're borrowing and I'm lending you a whole bunch of money, I don't want you paying any dividends until I get paid back as the bank. And so they're going to say, hey, no paying of dividends until you pay me back. And that's a contractual restriction. And that can affect your retained earnings. Okay, so a prior period adjustment is a very unusual affair. I have never had one of those, and thank goodness I have not, because that represents a material error in the past year's financial statements that are going to result in a change in the beginning balance of retained earnings. This is a big problem. If you have a prior period adjustment, that means not only I missed it as the chief financial officer, but my outside auditors missed it too. Nobody's going to be real happy with us if we have a prior period adjustment, I assure you. That probably you get to resign as a result of something that's that onerous. Any event, how do we handle it if we did? Well, we start with our beginning retained earnings, and here we expensed the cost of land instead, incorrectly expensed, and we take out the income tax benefit from that and put that back into retained earnings. And then we add net income from the current year, and we reduce our dividends from the current year, and that gives us our corrected retained earnings for the current year. Okay, I think that represents a good place for us to stop this video. And when we come back, we'll take a look at the statement of stockholders' equity. Until then, bye for now.